Usually, a medical breakthrough is a moral victory. Like we celebrate when a new drug or, I don't know, a better standard of care extends human life simply because it's the ethical thing to do.
Right, exactly.
But today, we're sort of stepping into this corner of the corporate landscape where keeping people alive longer isn't just a moral imperative.
Yeah.
It literally models out as compounded decade-long revenue growth.
Yeah, it's honestly one of the most fascinating alignments of, clinical outcomes and capitalist mechanics you'll ever see.
Right.
Because when their medical interventions succeed, their patients survive. And I mean, when patients survive, they require more ongoing treatments.
Which is, the whole business model.
Exactly. And those ongoing treatments just drop directly to the bottom line of this massive multi-billion-dollar operation.
So, welcome to Talk Tickers. Our mission today on this deep dive is to take a towering stack of Wall Street transcripts, regulatory filings, and clinical data, and just distill it into something you can actually use.
Cutting through the jargon, basically.
Yeah, exactly. If you've been following the healthcare sector, or if you just want to understand how macro policy shifts physically manifest inside a corporate balance sheet, you are in the right place. We're unpacking the Q2 2026 earnings call for DaVita Inc., ticker symbol DVA.
And, to really grasp what is happening with DaVita right now, we have to understand the sheer scale and just the fundamental nature of their operation.
Which is massive, right?
Oh, huge. They are a titan in the kidney dialysis market. I mean, they operate thousands of outpatient clinics.
Yeah.
For a patient with end-stage renal disease whose kidneys have effectively failed, these clinics are quite literally keeping them alive. They do it by, filtering the toxins from their blood multiple times a week.
Which means basically we are dealing with a business model built on indispensable, recurring, highly scheduled demand.
Absolutely.
I mean, this isn't like a software company hoping you renew your subscription, right?
Yeah.
Or a retailer hoping foot traffic holds up over the holidays. This is life-sustaining infrastructure.
It's literally life or death for the consumer.
Right. But as we are about to see, just because the demand is guaranteed doesn't mean the profit is simple to extract. So let's start at the very top of the ledger. When management got on the call to report their second quarter results for 2026, what was the immediate vital sign they broadcasted to the market?
The immediate signal was one of rigorous stability. So DaVita reported an adjusted operating income of $579 million for the second quarter.
Wow. $500 million in operating income in a single 90-day period.
Yeah, and that flows down to an adjusted earnings per share, or EPS, of $4.02.
What?
And perhaps the most critical number for anyone evaluating the underlying durability of this enterprise, they generated $256 million in free cash flow just in Q2 alone.
That's just a cash machine. And if we look at that $4.02 EPS figure, it feels almost perfectly calibrated. It's like checking a patient's pulse and finding a steady 60 beats per minute.
That's a great way to look at it, yeah.
There are no sudden arrhythmias here, no massive upside shocks, but also no alarming deterioration. It's exactly what institutional investors prize in large cap healthcare, which is just predictable, boring cash generation.
Totally. And the CEO, Javier Rodriguez, set that tone immediately. His opening remarks characterized the quarter's results as being broadly in line with their internal expectations.
Naturally.
Right, because when your adjusted operating income is hovering around that $579 million mark, and your overall enterprise-level operating income is up, about 5% year over year to $1.5 billion, you are signaling to the market that your operational machinery is highly tuned.
And kind of immune to the broader economy, right?
Exactly. Largely immune to broader macroeconomic volatility.
But, I always get suspicious when a massive corporation tells me everything is broadly in line with expectations.
Oh, for sure. It's the ultimate corporate blanket statement.
Right. A flat or gently rising top-line figure can act as this massive cover, hiding a whole lot of operational gymnastics going on underneath.
Oh, it absolutely does.
So if you're holding this stock, or if you're considering building a position, you cannot just look at that $579 million and walk away satisfied. We have to peel back the skin on these headline numbers and find out where those actual dollars are flowing from. Like, are they just finding clever ways to jack up prices, or are they physically pushing more people through the clinic doors?
And that brings us to the most fundamental unit of economics for DaVita, which is treatment volume.
Volume, right.
Everything in this company, the real estate, the nursing staff, the clinical trials, ultimately hinges on how many individual times a patient sits in a chair and gets hooked up to a dialyzer.
And the transcript, highlights that treatment volumes in their U.S. dialysis segment increased by 56 basis points year over year.
Let's ground that number in physical reality for a second. 56 basis points is just 0.56%.
It's tiny, yeah.
If I told you a tech startup grew its user base by 0.5% in a year, you would assume the company was dying. In the hyper-growth tech sector, absolutely they'd be done. But the U.S. dialysis market is mature, it's highly consolidated, and strictly gated by physiological realities.
Meaning, there's only so many people who get sick.
Exactly. It's gated by the incidence rate of end-stage renal disease in the broader population. You can't market your way into more kidney failure.
Wow. Yeah, good point.
So in this specific environment, grinding out positive volume growth of any kind is significant. And more importantly, the chief financial officer, Joel Ackerman, specifically noted that this 56 basis point growth actually exceeded their internal models.
Which pulls us right back to that paradox we mentioned at the start of the deep dive. Why did they beat their volume expectations? If the overall population of newly diagnosed kidney patients isn't suddenly spiking, where are these extra treatments coming from?
They are coming from a sustained improvement in patient mortality rates.
I want to spend some real time on this because it is the most striking, almost uncomfortable dynamic of this entire business model.
It really is.
When an analyst on the call, I think it was Justin Lake from Wolf Research, when he pressed management on this exact point, he basically asked, are you getting more new patients through the front door? Or is all of your growth coming from the fact that your existing patients just aren't passing away as quickly?
Yeah, he asked it pretty directly. And the management team was incredibly forthright. They confirmed that the benefit they saw in the quarter, the reason they beat their volume expectations, was entirely driven by mortality improvements.
Wait, entirely?
Entirely. The number of new patients starting dialysis was essentially flat. The growth is a direct mathematical function of patients living longer, thereby requiring more treatments over an extended lifespan.
It is wild to map a clinical victory directly onto a financial growth chart. Like they figure out a better way to manage anemia, or they improve cardiovascular monitoring in the clinic, and the result isn't just a better quality of life for the patient.
It literally models out as compounded revenue.
Over a 5, 7, or 10-year horizon, they are keeping people alive, and those people continue to need the service 3 times a week, 52 weeks a year.
Yep. Management also emphasized that this wasn't a statistical fluke or a one-time bump. They described it as a sustained improvement in mortality that they have tracked over multiple quarters now.
So it's the real trend.
Exactly. Now, they did concede that the first quarter of the year looked exceptionally strong because they were comparing it to a prior year that featured a brutal, highly lethal flu season for their vulnerable patient population.
Oh, that makes sense. The baseline was low.
Right. But even after accounting for that anomaly, the underlying organic trend of patients surviving longer continued robustly into Q2.
I have to imagine, though, that operating thousands of physical clinics across the country means it wasn't a perfectly smooth upward trajectory, right? A lot of things can go wrong when you are managing millions of individual appointments. So what was pushing back against that volume growth?
Well, there are always puts and takes in a logistics operation this massive. Joel Ackerman identified 2 specific headwinds that partially suppressed their volume growth. The first was a higher than expected rate of mistreatments.
Let's define that, because we aren't talking about medical malpractice here, are we? A mistreatment in this context just means a patient didn't show up for their scheduled session, correct?
Right. That is the industry term for a missed appointment. And for a dialysis patient, missing a treatment is incredibly dangerous, but it happens frequently due to the reality of managing a severe chronic illness.
What usually causes it?
A patient might be temporarily hospitalized for a related complication, meaning they obviously can't make it to the outpatient clinic. Or they might face severe transportation hurdles.
Oh, sure, because they feel awful after treatment anyway.
Exactly. And many of these patients rely on specialized medical transport, right? So if a van breaks down or a driver doesn't show up, that patient misses their slot.
And when the patient isn't in the chair, DaVita cannot bill for the treatment. But they still have to pay the nurses who were staffed for that shift and the rent on the building.
Yep. So an uptick in mistreatments is a direct hit to efficiency.
That's a brutal leak in the bucket. What was the second headwind?
The second headwind to volume involved their primary competitor, Fresenius. So the U.S. dialysis market is effectively a duopoly dominated by DaVita and Fresenius. Recently, Fresenius announced a strategic decision to close roughly 100 of their clinics nationwide to optimize their footprint.
Wait, which sounds like an absolute gift for DaVita. If the clinic down the street closes, that means the patient is Those patients still need dialysis to live. They have to go somewhere. DaVita must have modeled a massive wave of displaced patients walking through their doors.
They absolutely modeled for it, but Ackerman admitted on the call that the influx was slightly smaller than they anticipated. It ended up being about a 5 basis point drag against their internal projections.
I wonder why that is. I mean, if you are a patient and your Fresenius clinic shuts down, wouldn't you just go to the nearest DaVita?
It depends heavily on local geography, physician referral networks, and even something as granular as the specific shifts available.
Like the time of day.
Exactly.
Yeah.
If the local DaVita only has an open chair on the Tuesday, Thursday, Saturday evening shift, and the patient relies on family members who work nights for transportation, well, that patient might choose to travel further to a different Fresenius location that has a morning slot.
Well, wow.
The friction of switching providers in this space is surprisingly high.
That makes perfect sense. So we have the volume side of the equation mapped out. They are grinding out a tiny bit of extra growth, primarily because they are clinically succeeding at keeping people alive longer, which is slightly offset by patients missing appointments and a minor miss on capturing competitor market share.
Right.
But, volume is only half the story. You can perform 1 million treatments, but if you lose money on every single one, you go bankrupt. We have to look at the unit economics, we have to multiply that volume by the price, and then subtract the costs.
In the dialysis industry, those two variables are tracked meticulously through two acronyms, RPT, which is revenue per treatment, and PCC, which is patient care costs.
Okay, RPT and PCC.
These are the twin pillars supporting that $579 million operating income.
Let's tackle the revenue side first. The transcript shows that revenue per treatment, or RPT, increased by roughly $2 sequentially, meaning they made $2 more per treatment in Q2 than they did in Q1.
Yeah, and when you are doing millions of treatments, $2 drops a massive amount of cash straight to the bottom line.
What drove that price increase?
The increase was the net result of a very complex tug of war. Driving the revenue up, they benefited from favorable timing of payments in Q1 spilling over, a general increase in average negotiated rates with commercial insurers, and a seasonal dynamic involving patient deductibles.
Ah, the deductible reset. Because this is Q2, right? Mm-hmm. So patients have spent the first 3 months of the year paying down their high deductibles and hitting their out-of-pocket maximums. Yeah. So by the time April rolls around, the insurance companies are fitting a much larger percentage of the bill directly, which is generally a smoother, more reliable collection process for DaVita than chasing individual patients for copays.
That seasonal effect is incredibly reliable. However, that upward pressure on revenue was actively fighting against two massive structural headwinds. And if you are trying to understand the regulatory and economic tightrope DaVita walks, we need to spend serious time dissecting both of them.
So,
the first headwind dragging down their revenue per treatment is something management calls commercial mix degradation, which is directly tied to the expiration of Affordable Care Act subsidies.
Okay, this is the critical vulnerability of the entire American healthcare system laid bare in one company's earnings call. Let's really break this down, because the phrase commercial mix sounds like harmless corporate jargon, but it's actually the lifeblood of DaVita's profitability, isn't it?
It absolutely is. The reality of the dialysis industry is that the profit margin is almost entirely generated by a relatively small percentage of patients who have private commercial health insurance, usually through their employer or an ACA exchange.
Okay.
The reimbursement rates negotiated with private insurers are robust.
Because they have to be.
Precisely. They have to be robust because the vast majority of dialysis patients are covered by government insurance, specifically Medicare, which has a special carve-out to cover end-stage renal disease regardless of the patient's age.
Wait, really?
Yeah.
Regardless of age?
Yes. If your kidneys fail, Medicare kicks in. The problem is that Medicare reimburses DaVita at a significantly lower fixed statutory rate. In many cases, that Medicare rate barely covers the actual cost of providing the treatment.
Oh, wow.
Yeah, and for less efficient clinics, it operates at a slight loss.
So it is the ultimate cross-subsidization model. The private commercial insurance plans are effectively paying inflated rates to subsidize the losses DaVita takes on the government-insured patients.
That's exactly how it works.
So, the holy grail for any clinic manager is to maintain as high a percentage of commercial patients as physically possible. That percentage is their commercial mix.
Right. And what we are witnessing in 2026 is a steady, painful erosion of that highly profitable commercial mix.
Because of the ACA subsidies expiring.
Yes. During the height of the pandemic and the years immediately following, the federal government enacted expanded subsidies for the Affordable Care Act. This financial assistance allowed thousands of patients who otherwise couldn't afford it to maintain private commercial coverage on the exchanges.
But those pandemic-era subsidies are expiring now. The government support is pulling back.
Yes. And when those expanded subsidies disappear, the economic reality hits the patient immediately. A patient logs onto the healthcare portal, sees that their monthly premium has jumped from $50 to $400, and they simply cannot afford to effectuate the policy.
So they let the commercial insurance lapse.
Yeah.
And because they have end-stage renal disease, they don't just go uninsured. They fall back into the federal safety net. They transition onto Medicare or Medicaid.
The clinical pair doesn't change. They sit in the exact same chair, look at the exact same nurse, and use the exact same dialyzer.
But the financial impact to DaVita is instantaneous and severe.
Massive. A treatment that was generating a healthy profit margin yesterday is suddenly generating a break-even government rate today. Management closely monitors what they call effectuation rates, how many patients are actually paying their premiums to keep commercial coverage. And in Q2, they saw exactly the degradation they had feared.
An analyst from UBS, Peter Chickering, zeroed in on this dynamic. He asked a brilliant clarifying question, I thought. He wanted to know if this mixed degradation was solely being driven by existing patients losing their coverage, or if the brand new patients walking into the clinic for the very first time were simply showing up with government insurance from day one.
Yeah, and Joel Ackerman's response highlighted a structural shift in the broader economy. He noted that while they are seeing existing patients drop coverage, the more durable, long-term trend they expect to battle through 2026 and into 2027 is that new cohorts of patients are simply entering the system with a lower commercial mix than historical averages.
Which suggests a broader economic tightening. The pool of newly diagnosed patients simply has fewer people employed with strong private benefits than it did 3 years ago.
Right.
That is a macroeconomic headwind hitting DaVita's unit economics squarely in the jaw. We're going to look at the actual dollar amount of that damage later, but it is a massive piece of the revenue puzzle.
Now, what about the second major headwind pushing down their revenue per treatment? You mentioned something about phosphate binders.
This is a masterclass in how healthcare policy shapes corporate behavior. To understand this, we have to look at the biology of kidney failure. One of the primary functions of healthy kidneys is to filter excess phosphorus out of the blood.
Okay.
When your kidneys fail, phosphorus builds up rapidly. And high phosphorus is incredibly dangerous, right? It's not just a minor imbalance.
It is catastrophic over time. The excess phosphorus in the blood binds with calcium. It essentially creates calcification throughout the cardiovascular system.
Yikes.
Yeah, your veins and arteries can literally begin to harden into bone-like structures. It leads to severe cardiovascular disease, massive bone fractures, and a debilitating condition called pruritus, which is a deep, agonizing, systemic itching that patients describe as maddening.
Ugh, that sounds awful. Yeah. So to prevent their veins from turning to stone, patients have to take medications called phosphate binders with every single meal to grab the phosphorus in the digestive tract before it ever enters the bloodstream.
Correct. Historically, the financial mechanism for these drugs was disjointed. DaVita was paid a fee by Medicare for the physical dialysis treatment. Then, if a patient needed a phosphate binder, that was billed separately through a different mechanism, often Medicare Part D.
Okay, I follow.
And DaVita would recognize that specific drug revenue if their own pharmacy dispensed it.
But the Centers for Medicare and Medicaid Services, CMS, hates paying for things a la carte. They have been on a decades-long crusade to bundle payments together.
And that is exactly what happened here. After years of transition, CMS finally moved phosphate binders into the Medicare ESRD Prospective Payment System bundle.
Okay, let's translate that acronym soup. Think of the Medicare bundle like an all-inclusive resort.
Nice.
In the old days, Medicare paid DaVita a base rate for the hotel room, but every time the patient went to the buffet and got a phosphate binder, DaVita charged Medicare an extra fee.
Right.
Under the new bundle, Medicare just pays DaVita one slightly higher, flat fee up front. The room, the food, the drugs, it's all included in that one price.
That is the perfect analogy. And the explicit goal of CMS here is to transfer the financial risk. By paying a flat fee, the government is no longer on the hook if drug prices spike or if patients take too many pills.
They make it DaVita's problem.
Exactly. They make it DaVita's problem to manage the cost of those drugs within the confines of that single bundled payment.
And the CEO, Javier Rodriguez, spent a significant portion of his prepared remarks discussing this specific transition. He didn't sound defensive about taking on this risk, though. He sounded incredibly victorious.
Because DaVita turned a regulatory burden into an operational masterstroke.
Really? How?
Well, when you are suddenly responsible for the cost of the drugs out of your flat fee, you are highly incentivized to manage that process aggressively, right?
Right.
Because of DaVita's massive national scale, they were able to go to the pharmaceutical companies manufacturing these binders and negotiate heavily discounted bulk purchasing rates.
Oh, they flexed their monopsony power as one of the largest buyers of these drugs in the world.
They absolutely did. But the clinical side of the story is even more compelling. Before the bundle, because of the complex, fragmented billing and high out-of-pocket costs under separate pharmacy plans, thousands of DaVita's patients were relying on cheap, over-the-counter options to manage their phosphorus levels.
Like what?
Specifically, calcium carbonate.
Which is essentially just Tums. Patients with end-stage renal failure, facing vascular calcification, were popping Tums to manage a life-threatening complication because they couldn't afford the advanced prescription binders.
Exactly. It was a massive failure of the fragmented system. But once the payment was bundled, DaVita was financially responsible for the overall outcome. If a patient on Tums ends up hospitalized with a cardiovascular event, that disrupts DaVita's schedule and ruins their clinical metrics.
So what did they do?
DaVita opened up their formulary. They gave their physician partners the flexibility to prescribe the clinically preferred advanced prescription therapies. Rodriguez highlighted a stunning statistic on the call. They managed to reduce by more than 50% the number of patients relying on those less effective over-the-counter options.
That is an unbelievable quality of life upgrade for those patients. They got off Tums and on to real medicine, and it didn't cost them more out of pocket because it was suddenly baked into DaVita's bundle service.
Rodriguez framed it as the ultimate validation of value-based care principles. The government created a policy that aligned financial incentives with clinical outcomes, and DaVita executed it perfectly.
But let's bring it back to the income statement. How does this triumphant clinical story actually lower their revenue per treatment?
Because the accounting mechanics changed. Under the old system, they had a distinct line item of revenue coming in specifically for dispensing those drugs.
Okay.
Under the new system, they just get the flat bundle rate. The direct separate revenue stream for phosphate binders vanished sequentially, creating a downward drag in the RPT metric.
Oh, I see. But if it dragged down revenue, we have to look at the other side of the ledger. What did it do to their expenses? This brings us to patient care costs, or PCC.
And here is where the brilliance of their execution shines. Patient care costs per treatment actually declined by approximately $3 sequentially.
Wait, revenue went up by $2 overall, despite the headwinds, and the cost to deliver that care went down by $3. That is $5 of margin expansion per treatment across millions of treatments.
It's massive.
How did they achieve a $3 drop in costs in an inflationary environment?
It was driven by two massive levers. The first is the exact flip side of the phosphate binder transition we just discussed. Yes, they lost the separate revenue line, but because they negotiated those massive bulk discounts with the drug manufacturers, and because they efficiently managed the utilization of the drugs within their clinics, their actual cost to acquire and dispense those binders plummeted.
It is the ultimate middleman arbitrage. If Medicare historically paid out $10 total for the treatment of the drugs separately, and the drug cost DaVita $8, their margin was $2.
Right.
Now, Medicare gives them a flat $10, but DaVita uses its scale to buy that same drug for $4. They just doubled their margin on the spread.
And the beauty of it is that CMS is thrilled as well. The CEO pointed out that since this transition began, CMS has revised their estimate for total government spending on phosphate binders down by nearly $500 million.
That's crazy.
It is a rare scenario in American healthcare where everyone wins. The federal government saves $500 million. The patients receive vastly superior prescription drugs instead of over-the-counter antacids, and DaVita expands its operating margin by managing the spread efficiently.
That is wild. Okay,
Yeah.
so that covers the drug costs. What was the second major lever they pulled to drive down patient care costs by $3?
Operating leverage. This ties directly back to that 56 basis points of volume growth we analyzed earlier. Running a dialysis clinic involves massive fixed costs. You have to pay the rent on the building, you have to lease the expensive dialysis machines, and you have to maintain a highly trained core staff of nephrology nurses and technicians, regardless of whether the clinic is at 80% capacity or 95% capacity.
So when the volume grows because mortality is improving, They aren't necessarily building new clinics or hiring massive amounts of new staff. They're just filling the empty chairs on existing shifts.
Exactly the dynamic. If you can put slightly more patients through those exact same chairs, utilizing the exact same nursing staff that is already on the payroll, the average cost to deliver each individual treatment naturally compresses.
That makes total sense.
Management explicitly cited this operating leverage on labor and fixed costs as a primary driver for the lower PCC in Q2. They also pointed out a lower year-over-year growth rate in facility maintenance spending.
But the CFO, Joel Ackerman, did throw a bit of cold water on the cost celebration to keep analysts grounded, didn't he? It wasn't all just endless efficiency gains.
He had to manage expectations, yes. He reminded the market that if you look at the year-to-date numbers, their patient care costs have actually grown by more than 3% compared to the first half of the previous year.
Okay.
And that 3% growth was actually slightly above their internal projections.
Which makes sense. You can't out-leverage structural inflation forever. They have thousands of nurses who demand competitive wage increases, and the cost of basic medical supplies doesn't stay flat.
Exactly. Ackerman specifically called out higher employee benefit costs acting as a stubborn offset to those labor leverage gains. Healthcare for their own healthcare workers is getting more expensive.
The irony there is palpable.
Truly. But, much like the revenue dynamics, he stated that they expect the year-over-year growth in patient care costs to decelerate significantly in the back half of the year as some of these inflationary pressures annualize.
Okay, let's synthesize everything we've uncovered so far about the current state of the business. We're looking at a highly engineered corporate organism. They are squeezing out incremental volume growth simply by keeping their patients alive longer.
Yep.
They are staring down a structural threat as lucrative commercial patients lose their ACA subsidies and fall onto Medicare. But they're completely neutralizing that threat by brilliantly exploiting the new Medicare drug bundle.
It's honestly impressive.
They're upgrading patient care while simultaneously driving down their own drug costs and expanding their margins through operating leverage.
It is a profound demonstration of operational discipline. In a highly regulated, slow-growth market, they are pulling every conceivable lever, managing every microvariable to defend and maintain that $579 million operating income.
But defending the present is only half the job of a corporate executive team, right?
Yeah.
Institutional investors don't pay a premium for what you did yesterday. They pay for what you are going to do tomorrow.
Absolutely.
And while this entire Q2 story was largely about managing drug costs and navigating ACA insurance shifts, the management's forward-looking guidance reveals a massive technological pivot that fundamentally changes the long-term thesis of this stock.
Oh, this is the best part.
This isn't just about accounting anymore. It's about changing the standard of care. Let's look at what management told the market about the future.
Well, to set the baseline for the future, management first had to lock in the present. They came out on the call and firmly reaffirmed their full-year guidance ranges for 2026.
Let's get the specific targets on the record so you guys know what they're being measured against in December.
For adjusted operating income, they are maintaining their projection of a midpoint of $2.2 billion for the full year. For adjusted earnings per share, they're holding the midpoint at $14.65.
And what about that volume metric? Did the Q2 mortality improvement change how they view the rest of the year?
It significantly bolstered their confidence. Initially, they had guided the market to expect treatment volume growth somewhere in a range of 25 to 50 basis points for the year.
Right.
But because of the sustained improvements in patient survival we discussed, Ackerman stated they now expect to finish the year near the absolute top end of that 25 to 50 basis point range.
So the message to Wall Street is clear. The vital signs are stable, our margin expansion is working, and we are tracking exactly to the aggressive plan we laid out in January.
Precisely.
But if you dig into this sequential modeling, there's a very interesting anomaly in how they expect the back half of the year to play out. It's not a smooth, flat line from Q3 to Q4.
Joel Ackerman proactively highlighted this wrinkle to ensure the analysts didn't mismodel the upcoming quarters. He explicitly guided that they expect to see a massive sequential jump in adjusted operating income between the third and fourth quarters.
How big of a jump?
Specifically, a leap of $50 to $100 million.
An extra $100 million suddenly appearing in Q4 in a business that we just spent an hour describing as highly predictable and slow-moving. Where does a windfall like that come from?
It comes from a segment of their business that is fundamentally different from their traditional fee-for-service clinics. That revenue jump is largely driven by the timing of recognized income from something called IKC, or Integrated Kidney Care.
IKC is incredibly important to understand because it really represents the future of healthcare economics. Let's break this down. Integrated kidney care is DaVita's dedicated value-based care arm.
Exactly. In a traditional dialysis setting, DaVita operates under a fee-for-service model. The patient comes in, they filter the blood, and they bill Medicare or the commercial insurer for that specific event. They are incentivized by volume.
The more treatments, the more money.
Right. But in the IKC business, DaVita enters into contracts, often with Medicare Advantage plans, where they take on the holistic financial risk for the total cost of care for a defined population of kidney disease patients.
So they essentially stop acting just like a clinic and start acting like the insurance underwriter for that specific chronic condition.
Conceptually, yes. The insurance plan gives DaVita a benchmark budget for a patient. Let's say it's $100,000 a year to cover everything: the dialysis, the hospital visits, the medications.
Okay, that's a big budget.
It is. But if DaVita can proactively manage that patient's health and keep the total medical expense at $80,000, DaVita gets to share in that $20,000 of savings.
But if the patient crashes and requires a 2-month ICU stay that costs $200,000, DaVita might be on the hook for a portion of those massive losses.
Exactly. The risk is shared.
It requires an entirely different operational mindset. I mean, they have to employ dietitians to ensure patients aren't eating foods that will trigger a crisis. They have to coordinate aggressively with the patient's primary nephrologist.
Oh yeah, they're super involved.
They might literally send a specialized transport van to a patient's house just to make sure they don't miss a treatment and end up in the emergency room over the weekend.
It is intense, predictive, preventative care. And the reason the revenue hits so aggressively in the fourth quarter is largely an accounting and contractual artifact.
Meaning what exactly?
It takes time for the insurers to calculate the total medical spend for the year, right? They have to adjudicate all the claims and finalize the shared savings calculations. Those massive reconciliation checks tend to land and get recognized as operating income at the very end of the calendar year.
Ah, okay. That makes sense. So an analyst from Bank of America, Kevin Fischbach, zeroed in on this IKC dynamic. He wanted to know if this was just a neat trick to squeeze a few extra margin points out of their existing patient base, or if this IKC segment is a durable, compounding growth engine that could reliably add 1% to their overall bottom line year after year.
The response from both Ackerman and Rodriguez was aggressively optimistic. Ackerman stated unequivocally that he sees no structural reason the segment couldn't continue its growth trajectory for the foreseeable future.
Really?
Yeah, the strategy isn't just about wringing more savings out of the patients they already manage. It is about aggressively expanding the total number of lives under management by signing new, massive, value-based contracts with major Medicare Advantage payers.
Javier Rodriguez jumped in and described it as a maturing business, didn't he?
He did. He pointed out that predicting human health risk is incredibly difficult, but as they gather more data, as their predictive health evaluations get sharper, and as the coordination between the local clinics and the centralized IKC teams tightens, their ability to generate those shared savings becomes far more reliable.
It is a massive vector for growth that doesn't require building a single new physical clinic.
None at all.
However, as exciting as the financial engineering of value-based care is, it wasn't the main event of the forward-looking guidance. The topic that consumed the most oxygen during the CEO's prepared remarks was a monumental pivot in clinical technology.
Right, this is huge.
This is the absolute core of the long-term thesis for DaVita. If you want to know what this company looks like in 2030, you have to understand the technology they are deploying today. Management repeatedly emphasized the rollout of a new therapy utilizing expanded HD dialyzers, and they obsessively use the phrase middle molecule clearance.
To understand why this is a revolutionary step, we have to look closely at the biological limitations of standard dialysis.
Let's do it.
The primary objective of the machine is to act as an artificial kidney, removing harmful metabolic toxins from the bloodstream. For decades, traditional hemodialysis has been highly effective at filtering out small, water-soluble toxins like urea.
But the human body produces a vast array of waste products, and they aren't all small.
Exactly. There is a broader, deadlier range of larger, more complex toxins known collectively in the nephrology world as middle molecules. A prime example is beta-2 microglobulin.
Okay.
Because these molecules are physically larger, the pores in a standard dialyzer membrane are simply too small to effectively catch them. Traditional dialysis just lets them pass right back into the patient's bloodstream.
I use this analogy when trying to explain this to people outside of healthcare. Think about the air filter in your home's HVAC system.
Sure.
A cheap standard fiberglass filter is great at catching massive dust bunnies and pet hair. Keeps the system running. But it does absolutely nothing to stop microscopic pollen, wildfire smoke, or airborne viruses.
That's exactly it.
Those middle molecules are the microscopic smoke. Over the course of months and years, those larger toxins relentlessly build up in the patient's tissues and organs.
And the biological consequence of that buildup is devastating. The accumulation of middle molecules triggers a chronic systemic inflammatory cascade.
Which leads to?
It accelerates the cardiovascular calcification we talked about earlier, it degrades the immune system, and ultimately, it is a primary driver of the high mortality rates associated with long-term dialysis.
So the industry has known about this problem for years. How has it been addressed previously?
Well, in Europe and other international markets, they have utilized a therapy called hemodiafiltration, or HDF. HDF uses a combination of diffusion and convective pressure to physically force those larger middle molecules across the membrane.
Okay, so it works.
It is highly effective.
If it works so well, why hasn't DaVita just rolled out HDF across all their U.S. clinics?
Because HDF requires entirely different, highly specialized, and incredibly expensive dialysis machines.
The cost barrier.
Huge cost barrier. To implement HDF, DaVita would have to physically rip out their entire existing fleet of thousands of standard machines across the country and incur massive capital expenditures to install the new technology.
Which is just not feasible.
Furthermore, HDF requires massive volumes of highly purified replacement fluid, which adds intense operational complexity and cost to every single treatment. For a company that is legally bound to defend its free cash flow and operate within strict Medicare bundled payments, a multi-billion-dollar capital overhaul is economically impossible.
Enter the technological breakthrough, which is expanded hemodialysis or expanded HD.
Yes. Expanded HD attacks the problem from a different angle. Instead of changing the massive, expensive machine, bioengineers completely redesigned the disposable filter cartridge, the dialyzer itself.
Oh, that's smart.
They engineered a new synthetic membrane with slightly larger, highly uniform pores that can successfully trap those dangerous middle molecules without leaking vital proteins like albumin out of the blood.
So going back to the analogy, it is like keeping the exact same reliable furnace in your basement, but simply sliding in a high-performance, hospital-grade HEPA filter. Suddenly, the system catches all the microscopic smoke and pollen, but you didn't have to spend $10,000 replacing the HVAC unit.
That analogy hits the nail on the head, but, the medical community demands rigorous proof before changing a standard of care. Javier Rodriguez highlighted a massive, recently concluded clinical trial known as the Mother Trial.
What were they testing in that?
This was a direct, head-to-head scientific comparison between the expensive, specialized HDF machines used in Europe and the new expanded HD filters running on standard, traditional dialysis machines.
When you are running a head-to-head trial in cardiology or nephrology, the stakes are literal life and death. What were the specific results of the Mother Trial?
The trial achieved a critical statistical threshold. It demonstrated that expanded HD is non-inferior to HDF on a composite endpoint that tracked all-cause mortality and major cardiovascular events.
Okay, let's unpack the phrase non-inferior because it sounds a bit underwhelming to a layman. But in the realm of FDA approvals and clinical science, it is a magic word, isn't it?
It absolutely is.
It doesn't mean the new filter is vastly better than HDF. It means it is statistically just as good at preventing death and heart attacks.
And that is all DaVita needed to hear. They can achieve the exact same life-saving middle molecule clearing results without having to buy the $1 million specialized HDF machines.
Right.
Rodriguez laid out the strategic rationale in 3 distinct steps. First, it is an undeniable victory for the patients, providing them with a higher quality of life and giving physicians an evidence-based tool to fight cardiovascular decay.
Okay.
Second, it offers incredible operational advantages. The barrier to deployment is practically zero. They don't need to retrain their massive nursing staff on new complex machinery. They just unbox a different filter and attach it to the existing setup.
And the third step is the execution. The FDA recently approved a state-of-the-art expanded HD dialyzer manufactured by a company called Nepero. DaVita leveraging the massive purchasing power we discussed earlier, has swooped in and secured a massive guaranteed supply of these specific Nepro dialyzers.
Yes.
Rodriguez announced to the market that they intend to deploy expanded HD broadly across their entire national network in the coming quarters.
Which is huge.
Now, this is where the financial rubber meets the road. An analyst from UBS, AJ Rice, asked the multi-million-dollar question that every investor on the call was thinking. He effectively said, okay, you are rolling out this incredible life-saving technology across thousands of clinics. You are buying millions of these new advanced filters. How does this actually impact the economics of the company? When does this investment hit the balance sheet and drive up your EPS?
And the answer from the executive suite is the ultimate test of an investor's time horizon. Rodriguez was remarkably transparent. He stated that in the current year, 2026, the financial impact of rolling out this technology is completely immaterial. It is just absorbed into their current guidance.
Wait, nothing this year?
Nothing. And looking ahead to 2027, he admitted there will be some puts and takes as the physical rollout scales up, but the overall financial impact remains insignificant.
Wait a minute. They are fundamentally upgrading the standard of care across a massive national footprint, and they are openly telling Wall Street they do not expect to make a single extra dime of profit off it next year. How is that possible?
Because of the regulatory structure we spent so much time dissecting earlier. The true economic benefit of expanded HD cannot come from charging a higher price for the treatment.
Oh, right, the bundle.
Remember, the vast majority of these patients are covered by the Medicare bundle. DaVita cannot simply send an invoice to CMS and say, we used a fancier filter today, please send us an extra $20. The reimbursement rate is fixed. They're absorbing the cost of the better technology within the existing payment structure.
If they can't charge more for it, where is the return on investment? Why bother doing it at all if you were a ruthless, publicly traded corporation?
The return on investment is derived entirely, 100% from the mortality benefit.
Which means volume.
Yes. By effectively clearing those middle molecules, you reduce systemic inflammation. By reducing inflammation, you prevent major cardiovascular events. And by preventing those heart attacks and strokes, your patients live significantly longer.
Which brings this entire deep dive full circle back to the very first hook we discussed.
Exactly the point. When AJ Rice pushed the executives for a timeline on when the profits arrive, they clarified that they do not expect the positive mortality impact to manifest in their financial statements until 2028 at the earliest.
Wow, 2028.
It takes time. It takes time for the thousands of Nepro dialyzers to be physically shipped and deployed. It takes time for the accumulated toxins to slowly clear from the patient's tissues.
Right.
It takes time for their cardiovascular health to stabilize. And crucially, it takes time for that stabilization to translate into statistical longevity that physically adds extra treatment volume to DaVita's clinics.
It is an almost unbelievably long game for a modern public company. I mean, they are choosing to invest heavy capital in the standard of care today with the absolute certainty that they cannot monetize it through pricing power. The financial payoff is purely a function of organic volume expansion 3 years down the line because their patients simply aren't dying as fast.
Yeah, it's pretty profound.
It is a profound, almost beautiful business dynamic when you strip away the spreadsheets and look at the human reality of it.
It speaks volumes about the culture of the management team. They are deeply confident in their clinical science, their ability to negotiate supply chain economics with Nepro, and their impenetrable long-term position in the market. They are willing to endure flat margins on a new technology for 2 years to secure a massive volume tailwind in year 3.
Okay, we have covered an immense amount of ground. We have the 2026 guidance firmly locked in at a $2.2 billion operating income midpoint. We understand the value-based care jump coming in Q4, and we have fully mapped out the massive long-term technological play with expanded HD that won't bear fruit until 2028.
A lot of moving parts.
It is time to synthesize all of this. We need to give you, the listener, the ultimate verdict on how to view this stock and this company right now. Let's get to the bottom line.
Well, after heavily analyzing this transcript, reading the subtext of the analyst Q&A session, and projecting the trajectory of their clinical initiatives, I have to take a firmly opinionated, decidedly bullish stance on DaVita, specifically for long-term holders.
I expected a bullish verdict, but let's distill the core reasons why.
The primary reason is that DaVita has proven, quarter after grueling quarter, that it possesses the operational muscle to navigate incredibly complex hostile policy shifts while maintaining an iron grip on its cash flow.
Which they proved with the phosphate binders.
Exactly. Look back at the transition of the phosphate binders into the Medicare bundle. That was a 2-year regulatory headache imposed by CMS designed specifically to cap government spending and force the providers to take on drug cost risk.
It was a policy designed to squeeze the industry. And DaVita not only absorbed the complexity, they actively squeezed margin out of it by leveraging their purchasing power. And they managed to upgrade half their patients away from over-the-counter Tums to superior therapies.
It's brilliant. They turned a regulatory threat into a margin expansion event.
What else makes you bullish?
Furthermore, they are funding their own future clinical dominance directly out of their free cash flow, securing the massive supply of Nepro expanded HD dialyzers and orchestrating a network-wide rollout without needing to issue toxic debt or detonate their capital expenditure budget is a colossal competitive advantage. They are self-funding the next generation of care.
So the actionable insight for you, if you are currently holding DVA or considering adding it to your portfolio, is to drastically adjust your expectations regarding what kind of stock this is.
Yeah.
You cannot view this company as a high-flying quarter-to-quarter growth stuff.
No, absolutely not.
It is not going to double in a year. You have to view it as a relentless, steady compounder. It is a highly engineered machine designed to generate $250 million in free cash flow every 90 days by providing an indispensable life-sustaining service to a captive demographic.
But as any seasoned investor knows, every investment requires a margin of safety, a reason to believe the floor won't completely fall out if the market panics.
Right.
And DaVita possesses one of the most famous structurally reinforced safety nets in the entire financial world.
Let's talk about the Oracle of Omaha. We have to talk about Warren Buffett and Berkshire Hathaway because their involvement provides an incredible, literal floor for the stock price.
It really does. During the Q2 call, Joel Ackerman casually dropped a data point that is central to the bull thesis. He noted that DaVita repurchased 2.2 million shares of their own stock during the second quarter.
Okay.
And since the quarter ended, just in the month of July, they bought another 183,000 shares.
Corporate share buybacks are incredibly common, obviously. Companies use excess cash to buy their own stock on the open market, which reduces the total number of shares outstanding. When the share count drops, the earnings per share mathematically rises, making the stock look more attractive.
True.
But DaVita's buyback program is entirely unique, isn't it?
It is structurally unique. Ackerman explicitly reminded the analysts that DaVita does not just buy shares randomly on the open market. They execute targeted repurchases directly from Berkshire Hathaway every single quarter.
I want to make sure the mechanics of this are perfectly clear. Why are they buying directly from Warren Buffett?
They are executing these purchases pursuant to a very specific prearranged agreement they have with Berkshire, which is designed explicitly to maintain Berkshire Hathaway's total ownership of DaVita right at the 45% threshold.
Okay, let the math on that sink in for a second. Berkshire Hathaway owns essentially half of this multi-billion-dollar healthcare infrastructure. If DaVita were to just go into the open market and buy back millions of shares, the total pool of shares shrinks.
Right.
If Berkshire just sat there and did nothing, their percentage ownership would naturally tick up from 45% to 47% to 49% and eventually crossing the 50% line.
And neither party wants that to happen.
Yeah.
If Berkshire crosses the 50% threshold, it can trigger massive regulatory scrutiny, complex consolidation accounting rules, and a host of headaches Warren Buffett actively avoids.
So how do they stop it?
To prevent Berkshire from accidentally acquiring a controlling majority interest through the math of buybacks, DaVita simply agrees to buy the shares directly from Berkshire, shrinking Buffett's absolute number of shares in perfect lockstep with the shrinking overall float, keeping him perfectly pegged at 45%.
That is just, it's amazing. An analyst named Ryan Langston asked management if the recent movements in the stock price had caused them to reconsider this aggressive capital allocation strategy.
And the response from the CEO was a very polite but incredibly firm negative. Rodriguez stated that their view on share buybacks has been absolutely consistent. They spent heavily on repurchases in Q1, they continued buying aggressively in Q2, and year to date, they have deployed an astonishing $785 million of free cash flow, specifically on share repurchases.
When you realize that Warren Buffett's favorite holding strategy is essentially backing the floor of your stock, and that the company is contractually obligated to manage that massive 45% stake by systematically deploying nearly $1 billion in free cash flow, it offers retail investors a margin of safety that is almost unparalleled in the S&P 500.
Unparalleled, for sure.
It is the financial equivalent of a warm blanket.
It really is. However, no investment, not even one backed by Berkshire Hathaway, is entirely without risk. If an investor is going to hold this steady compounder, they must actively monitor the structural threats.
Right. So what is the single biggest risk you pulled from this transcript?
The primary risk, the one dynamic that could actively break their margin expansion, is the commercial mix degradation we spent so much time dissecting earlier. The expiration of those ACA exchange plan subsidies is a slow-moving train wreck for their unit economics.
Because they lose the high payers.
Exactly. As thousands of patients transition off private insurance and fall onto the lower-paying Medicare rolls, DaVita instantly loses its highest margin revenue. And management did not hide from this reality. They quantified the pain very clearly.
What's the number?
They view the lower commercial mix as a direct $40 million headwind to their operating income just in this current year, 2026.
$40 million in pure profit vaporized simply because patients had to change the color of their insurance cards.
It's brutal. And the projections get significantly worse before they stabilize. Management explicitly warned that the annualized effect of that lost commercial mix, combined with further expected degradation as more subsidies expire, will act as a massive $70 million headwind next year in 2027.
That is a staggering hurdle. It means DaVita has to physically find $70 million in new drug cost savings, or generate $70 million in new IKC value-based shared savings, or squeeze out $70 million in labor leverage just to tread water and stay perfectly flat against that specific regulatory tide.
And if the broader macroeconomy worsens, if unemployment spikes, and even more people lose their commercial employer-sponsored insurance, that $70 million crater could easily expand. It requires the management team to operate near flawlessly on the cost side just to offset the damage.
It is the ultimate stress test of their operational leverage, and it is the single metric every investor must scrutinize in the coming quarters.
Totally agree.
And that brings us to the final provocative thought for this deep dive. Something for you to ponder as you evaluate not just DaVita, but the entire healthcare landscape. We spent a massive amount of time talking about the rollout of the expanded HD dialyzers. We talked about how this new technology clears middle molecules, reduces inflammation, and ultimately improves patient mortality, which drives volume in 2028.
It is an undeniably fantastic clinical development for the patients.
But let's look at the ruthless business strategy hiding beneath that clinical victory. DaVita has used its massive scale to secure a guaranteed supply of these new Nitro dialyzers. They are aggressively rolling them out across their entire national footprint. Because of their purchasing power, they can negotiate the price of these advanced filters down so low that they can afford to absorb the cost within their existing flat Medicare bundled payments.
They're essentially raising the standard of clinical care nationwide without raising their own internal costs proportionally.
Exactly. So here is the game theory question to mull over. If DaVita successfully rolls out these expanded HD dialyzers across thousands of clinics by 2027, making middle molecule clearance the new de facto expected standard of care, will this force a permanent, insurmountable wedge between them and their smaller, less capitalized competitors?
Wow. It is a devastatingly brilliant strategic play when you think about it. Imagine you are the owner of a small, regional, independent dialysis chain with maybe 10 or 15 clinics. You do not have the massive purchasing power to call up NPRO and demand a steep discount on their new FDA-approved filters.
You have to pay retail price.
Right. Furthermore, you do not have the massive free cash flow or the operational leverage to simply absorb that extra cost within the strict confines of the Medicare bundle.
You literally cannot afford to offer the new technology without losing money on every single treatment. But here is the catch. The referring nephrologists, the doctors who diagnose the patients and decide which clinic to send them to, they all read the medical journals.
Of course they do.
They all know the data from the mother trial. They know that expanded HD is statistically proven to be better for their patients' cardiovascular health.
So if DaVita is offering this life-extending therapy on standard machines down the street and the independent clinic cannot afford to buy the filters, where does the doctor send the patient?
They are ethically bound to send them to DaVita. The superior technology becomes a non-negotiable clinical requirement that the smaller, undercapitalized players simply cannot afford to implement. DaVita isn't just trying to improve mortality to grow their own volume. They are structurally elevating the cost of entry for the entire industry.
They are effectively boxing out smaller competitors and independent clinics through a lethal combination of sheer clinical superiority and insurmountable supply chain dominance. It is a stark reminder that in corporate healthcare, the most effective competitive moats are often built using clinical trial data.
And that circles right back to the paradox we opened with today. We started by discussing how the diagnostic landscape of corporate earnings can be murky, how hard it is to see the underlying health of a massive company. But maybe, once you peel back the layers of the ACA subsidies and the Medicare bundles, it isn't murky at all.
No, not when you look this closely.
The financial X-ray doesn't show a traditional growth stock. It shows a very deliberate, highly engineered apex predator, an organism that feeds on complex regulatory shifts, digests them into operating leverage, and uses clinical breakthroughs not just to heal the patient, but to slowly, methodically suffocate the competition.
It is an ecosystem where doing immense clinical good is structurally indistinguishable from doing exceptionally well financially.
And that is a powerful, if slightly unsettling, vital sign to leave you with today. Until next time, keep digging into the data.